real estate world, just share some of the stuff off of my blog. I know you guys over there can't really see that well, so I'll try to be clear. Banks are still holding on to a lot of inventory, nothing new there, right? Something like 20 billion that they're just holding on to. At some point, some of it will trickle out. That's why we're not seeing a lot of inventory. Nothing new there. We've still got a whole bunch of the toxic lows. We're kind of right here. We went through the first big mountain. This is billions of dollars this way time here. You notice right after that last peak, we had a buying opportunity in 2008 for REOs. You guys remember that?
Yep.
We loaded up. We bought a whole bunch of them in 08. Well, that kind of dried up because we went through that. Well, this peak eventually has to come back out as inventory. So there is more coming. We just don't know when. And then there's one more mountain. So if anybody's suggesting recovery, I got to tell you, I don't think so. It's a little early. The data is overwhelming. What's interesting now is lenders have property in foreclosure. They're taking them out of foreclosure intentionally, and they're putting them in their non-performing pile. So rather than to finish it out and foreclose and it become REO or some third party buys it at the steps, they're putting it back into the non-performing to stay there and don't worry about it for now. So that's further decreasing the amount of inventory we have available. That's why all the investors are scrambling to find that one deal. Part of it too is a lot of it is they want to employ other methods like short sales. Loan mods they try to have very limited success on because most people default again, you know, it's just a free ride for a while. But short sales are the avenue they're kind of picking. Things have loosened up a little bit. It's taking not quite as long and approvals seem to be going a little bit better. So I think we'll get Rich to talk, we'll do a night on short sales, probably May or June, depending on availability. Because that's kind of the next frontier right now. That's where a lot of the money is going to be made. Here's an interesting graph. I know you guys can't really see it, but this is the percentage of homes that are underwater, the negative equity. And you see San Diego is really well represented. Yeah, there's a lot of houses here that are underwater, meaning more is owed on it than they're worth. And Sacramento, which is why I invest a lot, is also there. And a lot of you guys don't like Riverside, so I feel pretty good because 2 of the top 3 I'm in those markets, so that's good. Riverside is the #1 market. So you got more houses underwater than anywhere else. It's a beautiful thing. It's a good place to be. And once we're in the right place at the right time. It's kind of cool. And San Diego is definitely well represented. We're #3 statewide. So there's a lot of people here underwater, which means you can market to them to help them for short sales or mods or whatever it is that you're doing, right? Hopefully you can buy it at a number that works for you. There is no doubt we're now in the second leg of the downturn. We had that severe crash, and we came back a little bit. It was all artificial, it was stimulated by the tax credit and a bunch of other stuff, like shrinking down inventory. But that kind of dried up, and now we're having the second downturn. You got to be careful though, because our association, California Association of Realtors, they put a lot of bad press out. It's not really true. This is a chart showing prices from a year ago, and if you look at San Diego, they're saying from 1 year ago we're up 15%. Sacramento, where I buy a lot, we're up 7%. Well, the reality is no, our appraisals are getting cut back. Values are dropping. What's really happening is more expensive houses are being foreclosed upon. Better borrowers are losing. So more expensive properties going back out as REO or short sale. It's driving the price up artificially, but it's a very, very defaulting market. So don't believe, you would, based on that, you think, wow, recovery is here. We're up 7%, San Diego's up 15%. No, it just means they're deeper in the meltdown. More expensive houses are now going in. Okay? A percentage of total transactions. If you look at a market, if there's 100 transactions, you would think that most of them would be normal sellers with equity selling to people and getting a check when they close, right? Not the case. In Sacramento, 73% of them are either REO or short sale. That's a severely weak market. If you notice way down here, San Diego, we're at 33%. And that further shows that we're not as far along in the meltdown. The banks, the feds, whoever has calculated this out very strategically, they're holding out here more so than the inland areas. Does that make sense? Like Riverside, Sacramento, Bakersfield. They're letting those areas go first. They're holding pretty tight here. A lot of our sales just started hitting the market that are short sale and REO. 33 versus 73. So there's data to prove why there aren't very many REOs here or short sales. You just got to dig through it to find it. Is there a lot of cash right now sitting around?
Yes.
Does cash mean anything when you put in an offer and it's all cash? No. It seems like there's more cash than deals right now. In some markets right now, half the transactions are all cash. Miami, Las Vegas, Phoenix. Why? Because they've had the worst of the meltdown. People are going in, investors, and buying up whatever makes sense. And they're buying it really cheap. We're not there yet, but certainly Phoenix, Las Vegas, definitely. So if you think you're all cash and you're going to get a huge discount here, probably not. Everybody else is too. It's not that big a deal. Home prices are back to 1998 levels. If you look at pricing versus time, we're back. So we had a bunch of gain, we're giving it back. It's a pretty good deal. In certain markets, inland, people can actually afford a house in California. Imagine that. 4 out of 5 first-time home buyers can actually legitimately qualify based on their income. 4 out of 5, that's pretty good. It is still cheaper in some markets to buy than rent. Statewide, the average mortgage payment is $1,240 for that same house. The rent on it is $1,800. So what does that tell you? Might be a good time to go buy 3 rentals, huh? I mean, if you can make that kind of cash flow and prices are down, give the people what they're asking for. More people are choosing to rent than buy right now. Why? Fear. What else?
Lack of confidence.
Can't qualify. Lending is super tight. Absolutely, all those reasons. A lot of good people either went through a short sale foreclosure, it's going to be a year or two, or they're investors and there's just not much investor financing. And people are scared that prices are still falling. Absolutely. Builders are not building. New home permits are still way down. Why would builders not build? Can't sell. You can buy existing inventory way cheaper than you can build. Until that turns around, will there be much employment for construction? No. Is that going to turn the economy around anytime soon? No. What's it going to take for California? We got to put people back to work in the trades that actually make enough money to buy step-up houses, not service sector jobs. So look for that. That's a leading indicator. We watch that pretty closely. When that starts turning and people actually want to build again, maybe there's some recovery. If you look at the whole nation, there's about a third of them are renters, about 33% rent. 21% own houses free and clear. Kind of an interesting stat. Could we market to them with direct mail, write a good letter with some good copy on it and say, hey, I'm interested in buying your house? 21% of the houses in America are free and clear. Think about it. And the rest of them own with a mortgage. Unfortunately, a lot of those mortgages are upside down.
Yeah.
You can direct mail to them, but it probably be for a short sale. So much fraud going around right now, unbelievable amounts. Seems like in down markets, people just come out of the woodwork. This is a gentleman up in Northern California, took over 75 investors for $11 million, formed a pool, supposed to buy real estate, used it for personal expenses, leased the Lamborghini and the Land Rover. So when the Lambo wasn't working, the Rover wouldn't work either, it'd be in the shop too, so he needed a third car. Yeah, he had a couple, because both of those were in the shop. Frequently dining at high-end restaurants, lodging in luxury hotels. So be careful. If someone's asking you to invest, that's why, Justin, we're saying, well, what's it secured with? None of this, I'll just give you a check and you go buy real estate. What's my collateral? What's my security? Make sure you go through title and escrow. There's a whole bunch of fraud. We'll tell you some horror stories. Bruce and I got involved in one accidentally, so we'll tell you about it when we future meetings. Innocently, there's just so much of it. So be careful. Someone's asking you to invest. If you don't know how to properly protect yourself, email me. I'll try to walk you through it. I don't want to see you guys lose money. If you like this kind of stuff, check out my blog. I write about this stuff a couple times a week. If you don't want to go through all the websites and stuff, just cruise through there once in a while. You'll get most of this.